Now we are going to discuss the advantages of the short-term versus long-term capital gains. As we know, it can be advantageous to keep investments for longer if they're subject to capital gains tax once they're realized. The tax rates will be lower for most people if they realize a capital gain in more than a year. For example, suppose you bought 100 shares of XYZ stock at $20 per share and sold them at $50 per share. Your regular income from earnings is $100,000 a year, and you're a part of a married couple that files jointly. Now I'll explain how patience can pay off in lowering your tax rates with stock investments. If we buy 100 shares at $20 a share, the long-term capital gain would be $2,000. The short-term capital gain would also be $2,000. Suppose that we sold 100 shares at $50 a share. The long-term capital gain being $5,000 for both the long-term and short-term bracket. The capital gain in each of these categories is $3,000. We started with $2,000, we end with $5,000, that gives us $3,000. The capital gain tax for the long term is taxed at 15%, which is $450. Whereas for the short term, it's taxed at 22%, which ends up with a $660 tax bill. Profit after tax for the long-term capital gain would be $2,550, whereas for the short-term capital gain, it's $2,280. This is just a small example of how holding a stock for more than a year would save almost $300 in taxes. And just consider that many people buy a lot more in stock. So this is a very small example. You can multiply this by 10, you can multiply it by 100. By 10, you'd be at 3,000. By 100, you'd be at 30,000. So this just puts in perspective long-term investor versus the short-term trader. But also remember that longer you hold a stock, of course, you have more risk exposure. You have to consider all factors in the kind of stocks also that you're buying. Essentially here, you'd forego $450 of your profit by opting for a long-term investment gain and being taxed at short-term capital gain rates. But had you held the stock for less than 1 year and so incurred a short-term capital gain, your profit would have been taxed at your ordinary income tax rate. For our $100,000 a year couple, that would trigger a tax rate of 24%. The applicable rate for income over $84,200 in 2019. That adds an additional $270 to the capital gains tax bill for a total of $270. While it's possible to make higher return by cashing in your investments frequently and repeatedly shifting the funds to fresh new investment opportunities, that higher return may not compensate for higher short-term capital gain tax bills. To illustrate, consider the third-year impact of investing $1,000 for a higher income earning couple who pay the highest long-term capital gain tax rate of 20%. In this scenario, the calculations compared investing a long-run strategy with a series of short-term investments that were held for less than a year. The long-run strategy would yield almost an additional $20,000 over 30 years compared with a short-term approach. That holds true despite the long-term investment earning 10% a year versus 12% for each of the short-term investments. Making constant changes in investment holdings resulting in high payments of capital gains tax and commissions is called churning. At the end of the day, it all depends on the kind of trader that you are. If you feel comfortable and feel like you can maintain consistency, especially if you have a smaller account and you can really grow it, this may be suitable. But if you're really not into stocks or the stock market, you probably would be better off holding the stocks long term for tax purposes.